Welcome everyone to today's video lesson. Today we're going to do the end of the day squeeze. Now this shows up, hard to say, maybe once a week, twice a week, maybe, once in a while. So basically this is what it looks like. We have a big sell-off at the start of the day. Sells off, base is out, finds low a day. And at the end of the day, she squeezes up and takes all the shorts out. So look at that. The day ended nearly where it started. So how do we take this trade? Okay, so first thing to do is you gotta make sure that there's no news from the Fed. Like if there's a rate hike or something like that, interest rates going up, you want to stay out. You just want it to be a regular sell-off day. You don't want it to be a bad news day, because what will happen is you'll get to about here, and instead of it squeezing out, it'll take a second leg down and it'll just dump. So that's what you got to watch for. Now, normally, time of day is important. It happened a little bit early today. Normally, around the lunch hour, it doesn't do a whole lot. And by about, 1:15, 1:30, 1:45, you start to see it come up. And then you're looking for that trade right around 2 o'clock, 2:30. You can do a breakout around 3. And that's about the timing. So what we watch for is, and I took this trade today. We took it on we took the calls right here. So we took it at 110, cashed out 137%, and had I have kept them to the end of the day, it would have been up over 1,000. But we just take what we need. So this is how we do it. That's a footprint chart. We'll get to that in a minute. So you start to see it basically now. What do we see? Well, first of all, we got the moving averages. We got the 9, the 20, and the 50. So first thing you start to see is you start to see the moving averages cross. You got the 9 crossing the 20. That's when your ears perk up. That's when you start to go, okay, maybe we got something. And then you keep watching, and then you watch the 9 cross the 50. And then you watch the 20 cross the 50. So now we've got all the moving averages on the upside. That's the first thing you watch for, and it's the easiest thing. Second thing is you watch the price action. What do we got here? We got a low. We got a high. We got a higher low. This low is higher than this low. We got a higher high. Remember, this is on the 1 minute chart. We got a higher high. This high is higher than that high. Higher low. Higher high. Higher low. Higher high. Higher low. Okay? So, now it's starting to trend up. That doesn't always mean it's going to go up, but it's starting to. And then what do we get? It starts to level out. Pulls back a bit. And then she squeezes. This is short squeeze. This is shorts covering their position. These 3 candles like that. Pumps. Relaxes for a little bit. Pumps. Relaxes. Pumps. Pumps. You need to have an eye for this type of price action. That's short squeeze. That's not people buying. I mean, there'd be a bit of buying in there, but that's people covering their position from earlier in the day. There's shorts built up all from this whole day. Right in the morning. Shorted here, shorted here, shorted here. And they don't want to hold overnight because a lot of people don't have enough margin to hold positions overnight. Margin increases if you want to hold overnight due to gaps and stuff like that. So people need to get out of their positions. So they got in early in the day on, we had news today. A little bit of news, not a rate hike, but a little bit of news. And that's what drove the market down. So now we got to watch for the moving averages. We got to watch for the price action. And then you start to look for the squeezes. 3 candles in a row, straight up, squeeze, squeeze, squeeze. And then we get this snap candle. And that was quick. It just snapped right up and come right back down. There was a whole bunch of shorts. Their stops there. And the reason I know that is because when you look at the footprint chart, if you're familiar with these, This is just basically candlesticks with the orders on each side. So, you know, when this says 18, that means 18 people hit market order. This wasn't a limit order sitting there. This was a market order. And 9 people on this side hit market orders. So this is basically shows you where the aggression is. When you see this here, see how it says like 15 and 0? That means 15 people hit the market order, but nobody on this side, so sellers and buyers, so nobody bought from these sellers. These were just limit orders sitting there. So the reason I know that that snap candle was a lot of stops is because when you look at it right here, see all these zeros? There's a thin spot in the price action. Okay, and when you see that, that means there's a bunch of limit orders there. So look at all the people that sold into nothing, to, you know, all these buyers here too, they had limit orders, right? So nobody hit the market button, they had limit orders. So 15, so there would have been 15 buy limit orders, 19 buy limit orders, 13 buy limit orders. And why is there a buy limit order? Because shorts get down and they put their stop where? They put it right here, and then they put it here, and they trail their stop, and then it gets busted right there. You don't need to know that. That's just a little bit of market insight, but it's a good thing to know to put in your back pocket. So that's what you watch for. At the end of the day, you start to see it rounding. When the price action will start to curl, you get this curling shape. You see how it kind of comes down and starts to curl, and then it'll go exponential. And then the thing you gotta watch is about the last half hour of the day. If it goes up enough, it'll come right back down. So it'll dump that last half hour usually, because now all these buyers got to get rid of their positions, right? And then anything can happen in the last half hour, last 15 minutes. But more commonly than not, that last, you know, 20, 30 minutes, it'll dump, because now you've got all these, same thing, you've got all these buyers in here that don't want to hold overnight, that caught this move on the way up, so they're going to dump their position, and then the last 5 minutes it could go nuts. You have no idea what it's going to do. So yeah, that's a typical end of the day squeeze. Watch for it. So we want, first of all, you want a big sell off. It doesn't have to be too big, but just, you know, a decent sell off to build up a lot of shorts. You're going to watch for rounding. It looks like it starts to round and curl up. At the same time, you're watching for the moving averages to cross, and you're looking for higher highs, higher lows, higher highs, higher lows. And you get in, you can get in anywhere. This was a nice spot to get in. That's where I got in, because you can risk off of lows. So usually it'll curl up for a bit, and then it'll have a nice pullback too. See how these are about to, you know, they're about the same. This is very, very mechanical. You can see how it went up a certain amount and come back the same amount pretty much. Went up about the same amount, come back the same amount. Went up the same. So you want to wait for one that's kind of a bigger, because it'll do like a U. And that's the, you know, it'll chop up like that, and then it'll come down, and then that's where you want to enter. There'll usually be a nice pullback, and then you just risk off of lows. That's it. And you cut your, you know, you take most of your position off early, and then you just leave a couple runners, you know, and that's it. So that's the end of the day squeeze.